Welcome, everyone. It is so wonderful to have you all here with us today. Thank you for joining Tuck's virtual program. It is a part of our Tuck Alumni Lifelong Learning Program that today is brought to you by Tuck Alumni Relations and Engagement, as well as Tuck Center for Entrepreneurship. We are so happy to have you here for this exciting topic, and we hope you enjoyed that brief video about the 125th anniversary of Tuck. So we really feel the Tuck spirit and so happy to have you with us today. Before we get started, I would love to ask all of you in the chat to put what year of graduation at Tuck you graduated if you are a Tuck alum, as well as where you are calling or hailing from, so we can just get a little bit of a sense as to who is in the audience. And we also ask that throughout the program, you put any questions that you have in the Q&A. We will be in the Q&A box. We will be having an opportunity at the end of the program, about 15 minutes prior, to address questions that you have. We do know that this is an exciting topic, so we might not get through all of the questions, but just know that we will do the best that we can in order to get through those. My name is Heather Law, and I am the Director of Alumni Career Services here at Tuck, and honored to be a part of the Tuck community, but as well as virtual programs such as these. All year this year, we are putting on virtual programs at least 1 to 2 times a month that is celebrating the 125th anniversary. So we encourage you to join in on any of the future ones. You will be getting emails about those, etc. So great. It looks like we have a lot of wonderful people in the audience, all different years, all different locations. Oh, this is fantastic. Wonderful. Well, before I do formal introductions, we also just want to get a little bit of a sense as to your knowledge of ETA, so we can kind of know who is in the audience. You'll see 3 questions that will pop up on your screen. We ask that you take a moment to answer these, and then we can make sure that we share those and also have an idea of who is with us today. Wow, this is great. T17, T96 from Madrid. Fantastic. Oh, this is great. T18, 76. What a diverse array of alumni that are with us today from all over the globe. Fantastic. Oh, and we have a good couple of shout outs that are here in support of you, Mark, which is fantastic. So we love that. So we'll just give you one more minute to fill out the poll just about if you are planning to start your own search, how familiar you are with ETA, and if you are, how would you finance your search? Great. So with that, I'm just going to share the results so we have a little bit of sense. It looks like a lot of you are here because you know about ETA or you're excited to learn more if you can. Some of you are planning on starting a search, but maybe someday. I love it. Well, this will be a great opportunity for you to learn about the search. And if you were to, you don't know necessarily about how you would finance that search. So fantastic. Thank you all so much for sharing in that. And again, as we go through, please feel free to put in your questions. And with that, I would love to hand it over to my esteemed colleague, Eileene Oul, who is the director of the Center for Entrepreneurship at Tuck. We have been collaborating on many things, but most excitingly right now is this program. Eileene, I'd love to turn it over to you to introduce our guest speaker for today.
Wonderful. Thank you so much. Hi, everyone. We are thrilled at the number of folks that have signed up, by the way. It's a great turnout, so thank you for coming. And a shout out to the T14s. I see some folks in the audience. My husband, Jack, is a 14, so special shout out to those folks. By way of sort of level setting, I guess, because we have a bunch of alums from various years, we now have 6 centers at Tuck, and the Center for Entrepreneurship is one of those 6. We are really highly focused on students, experiential opportunities, and various practical learning opportunities. And it's really the key way in which students can customize their learning journey here at Tuck. And in our center, we focus on 3 student entrepreneurial types of roles or pathways: starters, builders, or acquirers. And today we're going to learn a little bit more about this 3rd opportunity. And so I'm really happy to introduce you to Mark, who teaches our ETA course here at Tuck. And this spring, he's introducing a new sprint course focused on new managers for that time just after acquisition. And several years ago, our center more formally stood up ETA programming based on the initiatives of a few students who really felt that it was important to bring this to the Tuck community, one of whom who went on to acquire it comes back and supports on a regular basis. Speaker series became a workshop series, which became a practicum, and it's now the course we have today, which Mark will not share. He's very humble, but it is at capacity the last 2 years, so it's a very well-loved course. Mark will be sharing his ETA journey himself, but what he also won't share is what a positive impact he's been here at Tuck. And while he's not a Tuck alum himself, he has fully embraced the Tuck community, and his passion for ETA and helping others is a major factor in the explosive growth in the students' interest in ETA. And so I feel really fortunate to work with him, and I'm really excited that he's now able to spend the next hour with you as well. And with that, I'll turn it over to you, Mark.
Eileene, thank you. Thank you for the kind words. Thank you, Heather, for the introduction. Also, I am indeed wearing my Tuck green today, although I am not, in fact, a Tuck alum. So I am going to get my slides going here. And Eileene or Heather, will you tell me if I'm doing this correctly? Are we looking good?
Yep,
okay,
you're looking
victory.
great.
Off to a good start. Well, it is such a pleasure to be with all of you. Heather, Eileene, and the team asked me to talk really about two things today. They happen to be my two favorite subjects, ETA and myself. So we're gonna go into both of those, maybe the latter in more detail than you want. Although I am going to start with that, so that you just get a sense for who's with you today. So as was sort of noted in the chat, pre-business school, I was in investment banking at Goldman, and then I worked in private equity. So I was in business school at Kellogg, really deliberating as to what I wanted to do with my career. And I had all of these just like raging entrepreneurial aspirations and all sorts of startup ideas. They were all varying degrees of lousy. And mercifully, I ended up not pursuing any of them. And as I'll describe in a little more detail later, I learned about search funds just before I went away for my summer internship. And when I learned about them, I thought it was ridiculous and not a real thing. But then I ended up convincing myself that it is. And I went ahead and raised a fund during my second year and searched for basically 2.5 years thereafter. So as I tell my students, I was, I think, the world's worst searcher. Not because it took me longer than anybody's. It has actually taken folks longer than 28 months. But the productivity of my search was just really lackluster. I had an investor, a really experienced investor, say to me at one point, "Mark, gosh, I like you a lot, but I don't like anything you're working on." So anyway, I ended up acquiring a company through luck more than anything else in 2012 as a childcare company called Little Sprouts, based north of Boston, which is how I ended up out this way. And yeah, I ran it as CEO for a little over 6 years. And then I sat on the board as chairman for a couple of years thereafter. And I share these statistics with you just to give you some context for what some of these ETA journeys can look like. So we basically delivered 9 times investors' money over about a 6-year period through 2 distinct holding periods. There was my search fund shareholder group. Then we sold in 2015 to a traditional private equity fund, and I continued to run it for those folks. And then we sold again in 2018 to a French strategic, which I'll tell you more about in a few minutes. And since then, since selling, I've really just been immersed in the ETA community, which I will tell you, I feel like is the most privileged place to get to spend time. So I've been investing in search funds just personally since 2015. Which is when that first liquidity event occurred, and I actually had the first dollar to my name. I've done some teaching at Kellogg on the subject, and of course, as Eileene mentioned, I feel really, really fortunate to get to teach the ETA course at Tuck. And I'm still today buying businesses through a holding company called Newbury Franklin. So I do think I've got a little bit of a diverse perspective as practitioner, someone who actually searched and ran a company, and then as an investor and board member. And as an academic. And this last bullet on the page is the main one I want to mention or underscore, which is I just think it is intoxicating to be around people who are betting on themselves, which is how I think of entrepreneurs generally and ETA specifically. And this silly picture is with one of my investor friends, and that was actually at a board meeting. So sometimes the board meetings are boondoggles. I'm gonna go away from my own journey now and actually talk more openly or objectively about ETA. So what is it? In a nutshell, and by the way, I meant to say this at the outset. I'm going to try to strike the balance today of being relevant to those of you who said, gosh, I already know a lot about it, and those of you for whom it's an altogether new subject. So that balance isn't super easy, but I'm gonna do my best. So ETA is an aspiring entrepreneur. Sometimes it's a team of entrepreneurs. Usually it could be two, sometimes three. They set out to buy a company rather than start one. And the key distinction relative to private equity is these entrepreneurs intend to step in to run the company day one. So private equity, of course, usually there's a management team already in place, or they install a management team. With ETA, the entrepreneur is the management team. There's two distinct phases. I already mentioned the search phase, which is dreadful. That's the first phase, and then the operating phase, which happily is much more fun. In the search phase, you are sourcing a deal just the way a private equity fund will. So you're out trying to get in front of business owners, you're screening deals, you're evaluating them, you're conducting diligence, and ultimately acquiring a single company. And usually that will come after hundreds or even sometimes thousands of businesses that these entrepreneurs look at. The operating phase is indeed, much more pleasant and happily goes on for a much longer period of time. Now, compensation. We'll talk more about this in a minute, but the long story short is there are forms of ETA where there is compensation. It's modest compensation, but where you can earn a salary while you search. There's another form of ETA where you earn no salary and you live off your savings. Either way, though, once you acquire the company, you ratchet up to a fair market salary for a CEO of a business its size and in its industry and so forth. But really the magic and why we all do this is for the equity. And the equity in ETA is really meaningful as a percent of the total business that's dedicated to the entrepreneur. And that's what we're all playing for. Sometimes there's distributions, those are more unusual. Really, it's the exit event that the entrepreneurs are playing for. So you might now ask yourself, like, all right, so I have a sense for what it is. Who might want to do this? The answer, sorry, I got ahead of myself. I don't have my confidence monitor that I have in the classroom, so forgive me. It won't be the last time I make a goof up. So why does it work? Very simply, there's this Venn diagram, and it's real powerful. So in the upper right, you have a high potential CEO. That can take the form of any number of you on this call. In the case of my class, it can take the form of MBA students. And indeed, freshly minted MBAs are charged with doing this all the time. It's totally credible to do it right out of business school. We overlay that with a solid industry. We'll talk more about that too. Good fundamentals that makes it difficult for the first-time CEO to break the business. And then we finally overlay it with a really experienced set of board members, investors, mentors who will help the CEO stay out of hot water. And over on the right, I just want to share what I consider to be the reason it makes sense for business owners, for the sellers of these companies. So the real magic is they get not only liquidity, but also a succession plan. Their alternative is to sell to a private equity fund, which in all likelihood is going to ask them to continue to run the business. So they cannot step away from the management, or to a strategic buyer. And often business owners don't want to sell to a competitor for fear that they may get rid of their key people and so forth. So liquidity plus succession plan is very powerful. And then from the business owner standpoint, sometimes they're aging, they're ready to transition out of the business. Sometimes they're just no longer motivated to do it because they've been doing it a long time, or maybe they've hit a ceiling from a competency standpoint. So it makes a lot of sense to hand the keys to someone that's going to step in to kind of take the next phase of the journey for them. And then finally, I call this the Wild West. It is among the only markets that I'm aware of where there's still quite a lot of inefficiency. It is indeed becoming more efficient over the last handful of years, but these businesses can still be bought really attractively. And it works. So the returns are pretty undeniable. Stanford has been studying this asset class for a long time. And these returns are certainly as compelling as I think any asset class that's out there. So probably not surprisingly, people are taking notice. There are more and more entrepreneurs who are aspiring to do this. It's been quite exponential over the last several years. I share with folks sometimes, just a sign of the times, that when Eileene described how the ETA course came about at Tuck, that first cohort was 19 students. And now today, as she said, we're at capacity of 75. And in fact, next year I'll be teaching a second section of the course because the interest is so strong. So it is really getting a lot of interest, not just domestically here in the US, but also abroad, as the chart on the right shows. Alas, it is not without risk. So this is from the Stanford study. And what this shows us is that half of folks who set off down this path end up with an outcome that is not the one they were seeking. They either fail to acquire a company, or they acquire a company and generate a loss rather than a gain on their investment. So that's a pretty harsh statistic in its own right. But the thing that I like to underscore is consider who is in that denominator. These are not slouches. These are typically folks that have gone to the best business schools like Tuck. These are folks that probably haven't failed at much of anything in their life. And here we are, like half of them end up failing. So I share this just because I think it's easy to romanticize ETA and underestimate the risks. Like, I know for my part, I underestimated the risks. And to say, and my students hate when I say this, there's just a lot of luck tied up in it. Nobody wants to hear it, but there is a lot of luck tied up in the outcomes here. So who's well suited for it? I like to distinguish between entrepreneurs writ large versus ETA entrepreneurs. So entrepreneurs of all stripes, I think, have many of these attributes. They're optimistic. They may not be risk seeking, but they're pretty risk tolerant, and they're open to foregoing the cachet of being in a blue chip company or a great name on the resume in service of building something of their own that they're proud of. ETA entrepreneurs, I think, have all those traits, but then these other ones too. They don't have a good startup idea. And I use this phrase business builder, and Eileene used a similar phrase in her remarks. These are folks who they would be equally happy running like a fancy AI business as they would a porta potty business. I mean, they really just want to build a business irrespective of its industry. There are some ETA entrepreneurs who have an industry thesis or focus, but most of us are pretty agnostic, and we just want to build whatever you put us in. And we're not really out there like being a visionary trying to change the world. All of us, though, I think are trying to solve for these characteristics. We want accelerated leadership, which I think is just code for I don't want a boss. We want to be independent financially as far as how we spend our time, and we all want just, again, the satisfaction of having really built something. So yes, indeed. Finally, now, like who would actually do this? And now I'm going to tell you a little bit more about my journey. So this is me at Kellogg. Surely people would not entrust that person with the preposterous hair to go and acquire and run a company, but indeed it happened. So I mentioned that I learned about this when I was just about to leave for my summer internship. So this is Rob Healy. Rob is a guy I worked for in private equity before going back to school. And I intended to go back to his firm after Kellogg. And we had lunch just as I was about to head to North Carolina for my summer internship. And in my mind, I was sort of breaking it to Rob. Hey, Rob, like, I don't think I'm going to come back. I want to do something entrepreneurial, but I just don't know what it is. And he said to me, gosh, Mark, why don't you go raise a search fund? And he said, I know I would invest, and I bet some of the other folks around here would too. And we could even give you an office and you could search here, and we could share deal flow. And I said, Rob, what's a search fund? And he went on to describe it to me. And as I said already, I thought it was asinine. I couldn't fathom how, at the time, I think I was 25, maybe 26. I couldn't imagine folks entrusting me to go and, raise real money and buy a company, and craziest of all, to run it. I just couldn't imagine it. In fact, I remember I called my dad when I left this lunch, and I said, Dad, I think Rob just told me I can go buy a company to run. And my dad, who, by the way, is my biggest champion, so this could be like misinterpreted, was like, Mark, I think you misunderstood. There's no way they're going to let you do that. But sure enough, I went away and I got my hands on the Stanford study and learned that it was a real thing. And I came back second year, just ready to do. I just couldn't understand why anybody would do anything else. Yeah, so I raised a fund during my second year, as I mentioned, and it is not for the faint of heart. It really isn't. I share this with my students. It is really, really daunting. But boy, is it fulfilling. And I'll tell you more about my journey here as we keep going. But I want to jump now to, okay, once you've decided you're going down the path to buy something, what are we actually looking for? And I alluded to this earlier, but really the crux of it is, let's buy something that is enduringly profitable. There's a great book out of HBS on the subject of buying these small businesses, and they always use the phrase enduringly profitable. So that's really what we're looking for. But what's really different about ETA, again, versus private equity, is we're looking for this opportunity to step in to run the company. So we're looking for a business where there's some reason to believe that the business owner will not be continuing in the CEO seat and that there's not an heir apparent to take over the company. So we want a leadership void because we ourselves want to step in to run it. And here we are with our key characteristics. We want recurring revenue and we want cash generation. And usually we talk about cash generation to the tune of like 1 to 2 million of EBITDA and ideally $2 million plus. It's a little different in self-funded land, which we'll talk about in a minute. But you want to have enough P&L capacity to be able to invest in a team, because really almost always these entrepreneurs step in and discover that while there are some great people in these organizations and many of them continue to have a home there, there's a need to level up the management team. And if you don't have P&L capacity, it's difficult to do that. And the recurring revenue is, yet again, just because we want the CEO, first-time CEO, to be able to wake up every day and be thinking about getting his or her arms around the business or eventually growing it rather than having to go and find $1 of revenue each morning. We'd like it to be a simple business. Doesn't have to be the most simplistic. There's plenty of kind of higher tech or software businesses that are acquired through ETA, but we want it to be something that the entrepreneur without tremendous domain expertise or background can reasonably get their arms around. Some folks have a target geography. I'd say that's becoming more common in recent years. So folks will conduct what they refer to as a geographically focused search to acquire a company in the geography where they currently live or would like to live. So I thought I'd just share this with you. This is kind of, I guess, turns out what I was looking for. This is actually a page out of the marketing materials that I used to raise the capital to acquire my company. So I thought I would just share with you. That's kind of what I showed my investors, and I think it gets at many of the same characteristics. It's a recurring revenue business. It's generating about 2 million of EBITDA, and it's also growing kind of nicely. So this is what I used to raise the money for Little Sprouts. This is really embarrassing. I'm at a hotel and someone's coming in the room. Okay, but now they left. Sorry for the disruption. Okay, so that's what I was looking for, or that's what I found. Now the question is, how do they actually go about finding these companies? And here is where it is quite similar to traditional private equity. This is where we're sourcing deals. There's two channels, a proprietary channel and a brokered channel. Proprietary is where we are, the entrepreneur is directly connecting with the business owner. It has a lot of really nice merits to it. You're dealing directly with the owner, the decision maker. It's probably not a competitive process. You're not paying a market clearing auction price. There's some real goodwill that's generated by virtue of going direct to the business owner. On the other hand, it takes a lot of outreach to connect with the business owner. You have to kiss a lot of frogs, as they say. So, you spend a lot of time trying to get in front of business owners who are not actually motivated sellers. And the other dynamic that's challenging in these small businesses is the quality of the books and records can be really wanting. So, in the absence of an intermediary helping them to bring the company to market, the information that you get your hands on in a proprietary process can be pretty challenging. So that's on the one hand. On the other, there's brokered, and this is where a business owner engages in an intermediary, an investment banker, or whatever it is to market the company for sale. This has lots of positive attributes too, namely that when you see a deal from a brokered channel, you know that you have a motivated seller, you know that there's going to be at least some amount of clarity on the books and records, and there is somebody is going to transact with this business owner. It just may or may not be you. The downside, of course, is you're competing with a whole universe of other buyers, and therefore the price is all but certain to be, a pretty high one. So I would say in search, at least in traditional search, which I'll distinguish between some of these phrases here in a minute, I think we prefer to see proprietary deals. Some of us as investors almost think of it as it's kind of what we're paying the entrepreneur to do, is to go and source a proprietary deal, because we can all get access to all the brokered stuff ourselves, although plenty of broker deals get done too. So I mentioned I was not a good searcher. I did, in fact, find my deal through a proprietary channel, but I used this kind of blind squirrel finding a nut thing, because the truth is, I just got super lucky. I could have gone to the beach for 28 months and probably had the same outcome. I just got one lucky phone call, and they say you make your own luck or whatever. And I was working hard to try to make this happen, but if that phone call hadn't come in, I mean, who knows where I'd be on my journey right now. Okay, so now let's recalibrate. So we've talked about why someone might do this, why it works. We talked about what they're typically looking for, how they're looking for it. So now let's just assume for a moment they found it, they've got the deal, and they're ready to go. So the next logical question, of course, is like, where do they get the money? So this is a very busy slide. I'm not going to take you through all of it. But what I've tried to do here is, on the y-axis are the variables that I think an entrepreneur is probably weighing when they think about the model they would choose to pursue a search. And then across the x-axis are the different models. So traditional funded, independent, self-funded, and so forth. So what I did would be described as traditional funded. This is the model where I went out and raised, it's called about $500,000 from 19 people. And the arrangement, there's a contractual arrangement between me and them. The arrangement is I get to pay myself a little salary and cover some of my expenses while I go look for a deal on their dime. But then when I find the deal, the contractual obligation is I have to bring it to them, and they have the right of first refusal to invest their pro rata in the equity that's required to finance the acquisition. And importantly, it is an option for them. It is not their obligation, so they can say yes or no. So that's in traditional funded. Contrast that with independent and self-funded, which I would say is becoming increasingly common these days. These entrepreneurs do not raise money up front. They go and live and conduct their search off their savings. And then when they find the deal, because they don't have that contractual obligation with a set of investors, they can go show it to anybody. And therefore, they can almost always get better economic terms. So I think of it as like a riskier path to search, but one that can have like really meaningfully better equity returns for them, if they're successful in finding the deal and attracting the money. Further to the right, the incubated and sponsored, those are similar, so I'll speak to them kind of together. This is a model where a single source of capital will support the entrepreneur while he or she or they go to look for the company to acquire. And then that single source of capital provides the equity to acquire the business. So even less risky, I would contend, than traditional search, because you've got really kind of more dedicated capital. On the other hand, I think the shortcoming here is you just have to really know and trust and like the folks, because they are, for all intents and purposes, your boss. Further off to the right is something that's become also quite popular in recent years. This is apprenticeship. Sometimes we call it CXO. There are private equity funds and other buyers of businesses out there who will actually like hire folks and install them as like a chief strategy officer, or sometimes as a CFO or whatever it is. And basically the premise is it's like a half step toward entrepreneurship. And then, later on, that person may choose to go and like put their hand up to be CEO. So the entrepreneur is kind of working directly for a sitting CEO. And maybe after that tour of duty, they're off to go buy their own business. So that's the sources of equity generally. I mentioned that there's been an explosion of interest in ETA, and I sort of spoke to the entrepreneur side of the equation, but equally on the investor side of the equation, it's just been really a lot of folks interested. So these are all different flavors of institutional investors that are dedicated exclusively to search funds in many cases, or ETA generally. I don't even bother to update the slide anymore because it gets so busy, but just know that like kind of each week, it seems there's a new institutional investor. And it harkens back to, what I shared earlier, which is that the returns are remarkable. And it's just a really fun community. It's a great place to spend time. I think a lot of folks find it to just be personally quite satisfying to work in the community. So that's on the equity side. Then we've got debt. It's not super easy to secure debt for these little businesses. Most lenders, if it's not at least 3 million of EBITDA, will have a hard time getting interested in it. There are some that will creep lower than that for sure. My deal, as I showed you, was 2 million, and I had a traditional bank provide, quite attractive debt financing. So it does happen. But really, the most credible source of debt financing for these types of deals, if you're self-funded, is SBA loans. And it's just, you need such little equity, as little as 10% of the purchase price in equity, which just makes the returns extraordinary. The downside, as many of you probably know, is that you do indeed have to sign personally a personal guarantee if you accept SBA financing, but the terms are so attractive. The next point I want to make here is I do think most entrepreneurs, including myself, underestimate the time and complexity associated with debt financing. So it's almost always the long pole in the tent in these deals. So I always encourage my students to really get out in front of the debt process. And it's hard when you are not with a traditional private equity fund, when you don't really have institutional gravitas. These lenders look at you with a bit of a raised eyebrow. Even with ETA as prominent as it is today, there is still I think a perception that you're just not as credible as a buyer as you are if you're an institutional fund. So sometimes they'll ask you to put up things like a deposit for their due diligence work, which is a lousy thing to have to do. So I just caution that debt is it's a tough part of the work here in ETA. Okay, so now we bought it. We bought the company. We got all the money. We own it. So what actually happens now that we own it? So as we know, we step in as CEO, which is even today, having seen this, I don't know how many times, I think it is just remarkable that these, often relatively young people, inexperienced people step in as CEO, and it works. It works largely in many cases because of the transition that the business owner, the seller of the business, will offer to the buyer. And those can be really wonderful, and they can go, awry sometimes too. But usually it's, a 3 to 6 month transition period. And then the wisdom says, and I totally subscribe to this wisdom, go slowly. At first, it is asking a lot of questions. I had a board member say to me, Mark, I want you to put your MBA hat in the closet. Maybe you can get it out in a year or so, but really, I want you not to make any big changes. I want you to focus on these things. I want you to focus on cash. I want you to focus on your customers. I want you to focus on your team, and I want you to refocus on cash. So we're not going to be making a bunch of big changes in the early months. We're going to really just try to get our arms around it. We're going to lean on our board as much as possible because there's a lot of things that we haven't seen before as a first-time CEO, and these folks can help us avoid expensive mistakes. And then, once we're comfortable in our own skin, we can start to set about growing the thing. And from there, they really do. I've seen a lot of them now. They take on a life of their own, and no two are the same. Not everyone ends up on stage with 1,000 teachers in an auditorium dressed as a Care Bear. And yeah, they do. They take on weird journeys that you would never expect. So in my case, I bought a multi-site childcare business, which sounds simple enough, and it is. However, the woman who was responsible for opening new schools at Little Sprouts resigned a few weeks before I bought the business. And it turns out when you're in a multi-site business, having the institutional knowledge or the core competency around opening multi-site businesses is really important. So, you know what? Yours truly ended up becoming the real estate developer. And, I had a crash course in real estate. I knew nothing about it. And I burned a lot of money making expensive mistakes. But yeah, I walked into this kind of scene and I was petrified. And now I walk into that kind of scene and it's ho-hum. I totally understand it. And I share that because I think these CEOs, it'll be something different for each of them, but they will learn a competency that they didn't have, maybe more than one. And, I find that it's been great that I now know how to develop real estate. So, yeah, I made a lot of mistakes, but I learned a lot. My team usually felt like this when I was developing real estate. So this was us trying to open one of our schools. This is poor Alyssa. So it was hard, but then, and this I share, and I know that those of you out there that have run businesses know this. So I get a little preachy on this one. It is all about the people. And I think in 2012, before I bought this company, I would have said to you, it's all about the people. And I would have meant it, but I would not have like felt it in my bones the way that I do now. And I do. I think that if you have the right team, I mean, you need to be in a good industry, but if you have the right team, it just all that takes care of itself. And conversely, if you don't, yeah, I think you can be in a great industry and still have a really hard time, and you certainly aren't going to have a lot of fun. So I don't know. I have come to believe that if you do nothing else as a CEO other than like really work hard to attract and keep great people, it's just all that matters. So I'm going to share this. This might sound a little self-promoting. I don't mean it to, but I'm still like very close with all these people. I left the business in 2019, so 6 years ago. So you wouldn't know it now because I look quite a lot younger there, but I'm the one in the rainbow shirt. The gentleman to my right, Kevin, is my now business partner. So we're partners in Newbury Franklin. The woman to his right, Melissa, was the sister of the founder of the company. She and I are still super close. We go on a walk together, I don't know, 3 or 4 times a year. Allison to my left, she called me 2 weeks ago and she's like, I finally left. She was there 31 years and finally left and wanted like some help thinking about what's next for her. Erica to the left, same thing. She left maybe 18 months ago and wanted to talk about it. And then sadly, the woman to the right, I have not stayed in touch with. But Sarah down below, I'm having dinner with next week. And she's gone on. She actually became CEO after I left. So I share it because like the special part of the journey in the end, yes, it's like it can be economically lucrative and invigorating, but I don't know. For me, it was, yeah, it just was all about the people. So this is just kind of an unnatural segue. So why am I showing you a Super Bowl slide? So this is when the Pats lost to the Eagles, and that would have been in 2018. I share it because I'll never forget the Monday after that Super Bowl game. I came into my office, I sat down, and I looked at my calendar, and had a series of meetings as I did every day. And one of them was with this French company that I'd never heard of before. And we came in, they came in, we met for an hour, we told our story as we had done many times before, and went on to the next meeting and didn't think anything of it. Later that day, they called and said, we want to buy you. And I said, well, that's wonderful, but we're not for sale. And they said, nonsense, everything is for sale, name a price. So I share that story because it was very much right place at the right time. I think it reemphasizes the point about luck. And we had built something special. And I think, by the way, a decent part of the reason they had such an interest in us was we had this kind of young, hungry team that I think punched above its weight for the, $30 million top line business we were at the time. So we ended up selling to them. It was a great outcome. Babalu remains the owner of Little Sprouts today. Little Sprouts ended up becoming sort of a house of brands. So we continued to open locations, but we also became a little bit of a roll up. And we didn't rebrand the stuff that we bought. We just left the brands alone for the most part. So yeah, that is it. And now I just get to run around with people like Jan to search fund board meetings and conferences, which are in all sorts of fun places all over the planet. And yeah, I just once again feel very, very privileged. So I'm going to pause here and see if there are any questions. And I don't know, Heather, do you want me to try to field them, or do you want to?
I'm gonna field the questions for you, Mark.
Okay.
That was amazing. Thank you so much. I feel like I can see why this is a course, and there's so many avenues to go down. So thank you. So fascinating. We have a ton of questions, so let me try to pull some of them together for you. A little bit about financing. So what tactical advice do you have for potential searchers as they gear up to raise a traditional fund? What time horizon should someone estimate from starting to raise a fund to beginning the search?
Okay, awesome question. This will be a bit of a verbose answer because there's a lot there. So let's start with these are in a traditional search fund, you're going to be forging relationships with your future business partners. And like any important relationship, the wisdom is in like investing in it, and having it be real and not transactional. So the advice that I offer on this subject is, I would get out there and meet with the human beings. Yes, most of them represent institutional capital now, but in the end, the GPs, like the folks actually making the investment decisions, are human beings. So go see them. I tell people, like, get out from behind the screen or the phone and go visit with them and get to know them, and build the relationship before you make the ask to have them invest. So the best searchers, in my view, are the ones that they spend many months, sometimes, many might be an overstatement, but they spend months going and building relationships. And then it's beautiful because it's a two-way street, right? You, as the entrepreneur, get to choose who you really pursue. You'll go meet with plenty of folks. They're like, their money is green. Yes, I would probably take it, but you're better than that. You actually want to assemble a cap table of the folks who you're going to go into battle with for the next, hopefully, 10 years. And you don't know that until you get to know them. And similarly, you want them to opt into you. You want them to be buying what you're selling. You may have an industry focus that just isn't of interest to them. So again, I know it's verbose, but it's like, I can't emphasize enough how important I think the relationship building is. And then timeline was asked about. That's harder to say. I mean, I've seen it done in as little as a month or two. And I've seen it take folks over a year. And some of it's to do with, are you gainfully employed and do you need to do this on the side? Some of it's to do with, is your story a tougher one to sell? And therefore, it's just going to be a little tougher sledding for you to raise the money. But yeah, it is hard to put a fine point on that.
Mark, can I just help you elaborate just on one part of that?
Yeah, please.
Came in about the outreach, about really being, broker deals, frustrated a little bit with starting to get going with outreach. Do you have a perspective around tactics? I thought that was really interesting what you said about, phone calls. Is that emails? Is it mailed letters? Is it all of the above? Like, how much persistence goes into this?
Yeah, for sure. So just so we're not confusing things, I was referring largely to the fundraising process. However, it does translate very directly to the deal sourcing process, which I think is what we're talking about now. So again, I do think a proprietary search is rooted in relationship building. I mean, really, as a general matter, like, we aren't the best buyers of any businesses. The only reason we emerge as the winning buyer is because we pay too much, which we don't want to do, or we have actually differentiated ourselves, usually in the form of a relationship with the business owner. So yeah, I mean, you'll do all the email, you'll do all the phone calls, and yes, you'll look at brokered stuff too. But as much as possible, you're trying to be in front of business owners. Like, I've heard searchers say, I evaluate my success day in and day out on how much of my day was actually interfacing with business owners versus everything else. The question started on how to think about brokered stuff, I think, early in the search. And there is, I think, some conventional wisdom that says, yeah, it's great to see some brokered stuff early on and spend more time on that, because you're going to get some reps, especially if you're not out of the deal business. You'll start to understand the process of what it looks like to evaluate a business, to conduct preliminary diligence, to submit a letter of intent. So it is good to get some of those reps. And the other nice thing about brokered deals is, it may turn you on to some industry ideas that you hadn't considered. So there's all sorts of good reasons to do that. And certainly the advice we give searchers is, like, ideally you're doing a lot more of that at the outset, and hopefully you're doing very little of it. At least the time allocation is much less later in your search.
I love this question. Common issues which lead to ETA failures. Anything you've seen in your own personal world, or those wonderful colleagues too?
Yeah, so we do a whole session in my ETA course on when it goes awry. I share that I made so many mistakes. So the main reason in the search, in my view, that it doesn't lead to a successful outcome is inefficiency broadly, and I would say more specifically, spending a bunch of time with business owners who are not motivated sellers. So you're desperate for business owner interaction when you're searching. And I can't tell you the number of times I thought to myself, gosh, if I just squint hard enough at this deal, maybe I can find a way to talk myself into it working. And anytime I was doing that, I was just deluding myself. So, like, spending time with business owners that aren't actually motivated sellers. Number two, just not getting enough high quality volume into the top of the sourcing funnel. So by that, I mean, like, we're just not getting enough outreach to these business owners, or it's not high enough quality that it's breaking through the noise. So just not enough looks is the other thing. So those are the two reasons I see folks struggle to get deals done. Then when we're operating the business, gosh, I mean, there it's like just like any business. I mean, it usually begins and ends with team. Maybe we got ourselves into a bad industry. Sometimes there have been diligence oversights. I'd say that is more the exception than the rule. I mean, the nice thing about ETA is this community, it is supportive and it has seen it all. And the investors are not meddlesome, but they are looking over your shoulder. So you're typically not having big diligence whiffs that you're then having to suffer through once you're running the company. I mean, really, when things don't go well in that phase of the journey, it is just like maybe the CEO moved a little too quickly on some bad decisions. Maybe they had some hubris and weren't really listening to their board. But if it's kind of a ho-hum mediocre outcome, more often than not, they just didn't get aggressive, in my opinion, did not get aggressive enough in building their team, or they picked the wrong industry.
So great. These are so great and so many wonderful questions coming in. For someone who doesn't really have a PE or VC background, which may offer some of the natural transferable skills that you talked about, are there skills and experiences that would be helpful to build, or any advice on building networks to get closer to the ETA community?
Yeah, so I'll address the second part of the question first. So it has become very easy to get plugged into this community, happily. It used to be this kind of small cottage community that you had to like navigate to this like small handful of people, and if you didn't do that, then you're out of luck. But now, I mean, there's all these institutional funds, all those logos that I shared earlier. Those folks all have junior or mid-level folks on their team who their whole job, or maybe not their whole job, but an important part of their job is interacting with would-be searchers and helping them navigate this whole like undertaking. So reaching out to any of those funds, I think, is a very easy way to start to network. I think there's also, I mean, we have all sorts of resources here at Tuck that you can avail yourself of. There are places like searchfunder.net, which is just like one of these online communities that you can go and compare notes with people. So there's a robust network out there, not difficult to tap into it. With respect to the transferable skills, I think that's a provocative question. We always say to students and searchers, every one of you is qualified. If you were admitted to Tuck and you graduated from Tuck, like, you are qualified to run one of these small to mid-sized businesses. Could you do some work around like financial modeling or whatever to ensure that you are equipped to really understand the financial implications of your deal? I think that'd be well served, but I don't know. I'd rather see you start thinking about compelling industry ideas and starting to actually search than trying to like bolster your credentials.
Great. Another question about maybe the incubated example that you gave. The example that this person gives is that with their concept, it feels like a mashup of venture studio, development shop, and potentially a search fund. And so does this fit the incubated mode you describe? And likewise, do you see more blurring of the lines between ETA and other models?
Yeah. So what I would say about the incubated models is they have evolved. So it used to be that there was just a handful of funds that would basically go and recruit a cohort of MBA students and would give them resources to go and conduct a search. So they wouldn't search for them, but they would give them resources to they didn't have to create their own deal sourcing engine, and they got kind of a running start on the search. And then those funds would provide the equity. What happens now is like there's actually, really conventional big institutional private equity capital that is doing similar work with aspiring entrepreneurs. And so when I think of like models blurring, I mean, that is one way I see them blurring. Frankly, and I hate to disclose my ignorance, I don't know as much about some of the venture studio stuff, so I'd be like speculating a little bit, which I'm reluctant to do.
They're great. They keep coming in fast and furious, Mark. So thank you for handling all these with just such grace and poise. Interesting question about in an independent search, is it possible to bring in investors after you found a company? And how does that happen? Are the investors the same as the search fund investors?
It's a great question. So not only is it possible, I'd say it is more common than not. So it is the unusual situation is the entrepreneur does not raise any money, goes and finds a deal, and has the personal balance sheet to go and buy it him or herself. That does happen. There's plenty of precedent for it. I have folks come into my ETA course who have done it that way. But the way it typically works is that entrepreneur will find the deal. They'll go and round up their SBA loan, and then they'll go and find the equity for the remaining like 10 to 25% of the purchase price. And those folks can be anybody. And often there are people, they can be people from the traditional search fund community, although there is less overlap than you might expect. I'd say that the folks that invest in traditional search funds are really rooted in a very long-standing economic arrangement between the entrepreneur and the investor. So there's a 25% incentive equity potential for the searcher, and then 75% to the investor. Contrast that with what we're talking about now, which is like the independent approach. Often those entrepreneurs will go and get 80 or 90% of the equity. So the investor that is accustomed to the 25-75 split is not always, real enamored with like the 90-10 split. So that's why they often are different people. A lot of times these investors will come out of the entrepreneur's network. There is like, I think, a little bit of resource at Stanford and Harvard around how to tap into some of the independent, like self-funded investor networks. And again, I would say like searchfunder.net is another place to get referred to investors.
Two more questions on financial component. What kind of personal guarantees would banks ask for with SBA loans?
Yeah, so it is. So I have not signed one myself, so I'm a little over my skis in responding to this, but it is an exhaustive personal guarantee. I will tell you, you do not hear many stories in the search fund community or the ETA community of folks who sign those guarantees and having them invoked. In fact, I've never heard of an entrepreneur having their personal guarantee enforced. So that doesn't mean it doesn't happen, but it's not very typical. But yeah, I mean, you pledge all your assets, you pledge your house, you pledge, all your assets when you sign personally for something.
Great. And what percent of price can be seller financed and tied to their continuity?
Yeah, I mean, seller financing, I'm actually glad that, thank you to whoever asked that. That was an oversight not to address that in my remarks. Yeah, seller financing is a really important component of the like capital stack to finance one of these. So, it's not unusual to ask a seller to finance, I mean, at a minimum, like 10 or 20% of the consideration. I mean, sometimes 40 to 60%. I mean, every deal is different, but especially in these really small businesses, let's call it $1 million or $1.5 million of EBITDA, those sellers don't often have a lot of alternatives. And as a result, they're sort of forced in many cases to extend financing to the buyer. So it can be quite significant.
Wonderful. Okay, well, let's end on this last question. How do you prevent an investor that you're working with from swooping in and purchasing the business themselves?
Oh goodness, that is, I can actually see that. You know what I would liken that to? So I'm not a startup person, as I've admitted. But you hear entrepreneurs say like, or like inexperienced entrepreneurs will say like, oh, I don't want to share my startup idea. I'm afraid someone might take it. But then you actually talk to like experienced entrepreneurs and they're like, that's hard work to start a business.
Yeah.
Even if it's like a great idea, I'm not going to I could tell everybody on the planet and nobody else is going to go and like copy it. And I think that's true here in ETA land as well, where like these investors are not organized to go and like do the work themselves to go and buy the business. I mean, they are squarely in the business of capital allocation. And indeed they rely on people just like whoever asked that question to do that work. It's not work they're interested in doing, I can assure you. I've never heard of that happening.
Exactly. Well, this was so wonderful. First of all, you're getting tons of comments about what a great job that you are doing, Mark. So thank you so much.
Oh,
And
that's very
yes,
nice
these
to hear. Thank
slides
you.
will be available. The virtual program will be available on the My Tuck archive. So all of the wisdom that Mark shared, you will have access to again. We can't thank you enough, Mark, for this. I know we could go on for hours because you are so terrific and just have a wonderful way of talking about something that's complex in a really articulate manner. And we encourage all of you to join us for future virtual programs. Like we said, we have a terrific lineup coming up for the rest of the year, at least once a month. You will notice that we have the 125th anniversary programming. I want to say a huge thank you not only to Mark, but also Eileene. It's been so wonderful to partner. You can definitely check out the Center for Entrepreneurship website. They have all their information and resources, and just really want to say thank you again for that partnership and encourage you all to come to many of the upcoming programs that we have. So thank you for being a part of the Tuck community. Mark, Eileene, and everyone behind the scenes, thank you for this wonderful program.
Thank you, Heather. Thanks, Eileen. It was great being with all of you.
Thanks.
Thanks, everyone.